By the end of this video, you will understand why the market is in a little bit of chaos right now and what to do going forward. How's it going, world? Michael EJ here, helping you become the best investor you can be so you can reach those financial goals and dreams. If you're new to the channel, what's up? Mainly talk about the stock market here, and more importantly, how to think differently than the market. Because you want to beat the market, you gotta think differently than the market. So if you want some differentiated ideas, make sure to subscribe, like this video, and let's get started. So what a week for the stock market, right? I mean, you got 2 days where the Dow is down 3+%. Then you got a little bit of a pop back at the end. And some stocks really suffered, others not so much. So let me talk to you about what exactly happened, what's been happening, and what's going to happen going forward. First and foremost, number one thing, a change in expectations happened. What you have to realize is that a lot of what's been going on in the stock market right now is directly connected to moves and decisions made by central bankers across the world with financial easing, monetary policy. A lot of that's kind of fueled the stock market. When there is that happening, people expect the economy to get better. When the central bankers see a little bit of trouble, they lower interest rates. A lot of people in the stock market see that as in 1 or 2 years, things will get better. The economy will eventually improve, and investors look forward. Investors always look forward at least a year or two. So they see that, they're like, okay, things are going to get better, which is why usually the stock market turns around before the economy actually does. And why the stock market is used kind of as a forward-looking tool by economists. And I mean, it's just for that simple reason. So when all this good economic data continues to come out, continues to beat expectations, unemployment is like what? Is it below 4% now? Unheard of levels. Jobs are still being created, and now you have to worry about inflation. It used to be only the top, or people that were in certain professional fields were only benefiting from all these moves from central bankers and the economy. Now everybody's starting to benefit. When everybody starts to benefit, wage growth starts to increase. And when wage growth starts to increase, inflation is right behind it. And that's what central bankers do not want. They do not want inflation. They do not want prices taking off. Everything, you don't want to walk into the store and milk is twice the price as it was just last week. That's what we're trying to prevent. We do not want that happening. That ruins an economy. So while central bankers are trying to control that, the best way to control it is keep the economy from not being overheated. Now, in doing so, because all the good data is coming out, a lot of people in the market thought the Federal Reserve might raise interest rates 2 or 3 times, maybe, over the next year. If this good data continues to come out and inflation really starts to pick up, just to get ahead, central bankers might raise those interest rates globally, not just the Fed here in the United States, globally, more faster than what the market expects. That's what triggered everything going awry. On top of that, it's more of a technical sell-off in that a lot of this had to do with really products that's never seen or gone through a market turn. ETFs, for example, how many ETFs were around to this extent, were around during the 2008-2009 crisis? And how invested were they? I mean, it wasn't that many people investing in them. I mean, now, today, there's more ETFs than there's actually stocks, at least in the US. It's ridiculous, and it's starting to look that way in other parts of the world too, just to gain just to gain international exposure. So you got that really going on. I mean, the inverse VIX, short volatility. I mean, you got people got to remember, volatility, it goes down like going down the stairs in a building, and it pops up like going up an elevator. Like you can't, who would short that, right? But it was a really successful trade until it wasn't. So you have that going on. You have ETFs going on, which if you're in a stock that's in a lot of ETFs, it can get kind of scary because it might drop down further than you expect, because it's not just selling from the individual stock, it's selling from the ETFs. So I'll talk about that a little bit later, but a lot of those things just came to play, and maybe more of a technical sell-off, but more of a change in expectations. Which leads me to my next point. We are about to enter a range-bound market, sideways market, where overall, maybe over the next year or two, maybe even 3 years until things really get bad, the S&P 500, the market, might end up flat or a little bit better than flat. And here's why. And it's talked about by, I forgot the guy's name, but his book is called Active Value Investing. One of my favorite books of all time. Never heard anybody talk about this subject. I'll make sure to leave a link to the book as well as a presentation about the book below. But essentially, he makes the argument that you have bull markets, bear markets, and range-bound markets. In a bull market, both earnings growth and the multiple, PE multiple, go up. They both expand. They both do well. In a bear market, they both come down. In a range-bound market, usually earnings growth is still good. Earnings growth is still good. But the multiple comes down. Sentiment gets worse. And it comes from a variety of things. Even if the company's doing well, they might not be doing well enough relative to expectations, or just things just happen in the market where good vibes aren't there. Kind of like last week. So you need to protect yourself from a range-bound market. I know I just made a video about why value investing isn't the best way or isn't the long-term solution going forward if you want to beat the market. But it's the solution right now, today. Quality value is the way. You gotta pick stocks that you can find that are trading at justifiable valuations. Now, there's different ways to find that, and I have a video coming up about that, like how to find a company that's trading at justified valuation, even if it's high. Regardless, you need to look for companies that's trading at justifiable valuations so that when the multiple comes down with all the sentiment changes, your multiple won't come down that much. Like, you gotta think about protecting downside. You gotta have some growth prospects. You gotta have some growth in there. So decent growth without the multiple just falling through the roof, and you're gonna make it out just fine in the next couple of months, even a couple of years. Now, to really protect yourself, you need to avoid risky, crowded names. High risk names that a lot of people are piled into. First of all, I'm going to talk about crowded for a second, because of this ETF craze, crowded names they're hidden. It's a hidden way to add like leverage to your portfolio. I'll leave a link below to an ETF database where you type in the ticker of the company you're invested in or interested in, and see how many ETFs is in, and see how many ETFs is at the top. Like, they're one of the top holdings. You look at the FANGs, you look at Boeing, you look at Starbucks, all these companies are in like 200 plus ETFs, and they're like top holdings in a bunch of other ETFs, like dozens. It's ridiculous. I mean, that is like a hidden way to add volatility to your portfolio, and you might not expect it. And these are the good names. These are names that at least have some quality. Look at some of those names in the S&P 500 that aren't so good and are a little risky. I mean, just this past week, the S&P fell further than the Russell. I mean, all the small and mid caps, they didn't fall that far hard. I mean, it doesn't make any sense. And I think the ETF craze and the fund flows into ETFs plays a major role that people aren't talking about. So first, you got to avoid that crowded part. And then you have to understand the risk of your portfolio. A lot of people don't think about risk. They just see growth, risk, value, not risk. There's more to it. I have a video coming up talking about how to measure risk for each individual position in the portfolio. It's more than beta, it's more than valuation. There's much more to it. But if you're in a risky name and it's crowded, more than likely crowded as in you're in the S&P 500, watch out. Those are names you need to stay out of. Look for names that aren't in really the ETFs or aren't in some of the major ETFs that are out there that measure crowded names. Like, try to venture off, go off the beaten path. I've always been a fan of looking at small and mid caps. I suggest you take a look at them too. And that's what I have for you all today. Guys, It is all about protecting downside in these moments. Remember, it always hurts more to lose than to win. It always hurts more. So you need to avoid trying to lose. Don't lose that much money. Take profits however you can. Watch out for the changing expectations. We're in a range-bound market, so don't buy things that are too high and avoid risky, crowded names. Michael EJ here, helping you reach your financial goals and dreams by becoming the best investor you can be. And I'll see you in the next video. Peace.